Hi, I'm Franne McNeal with a business growth tip.
Three financial statements that help us. I'm going to do a quick version here. The first is the income statement. And here's where I was starting that quick formula. You want to know what your sales are. You want to subtract out what it costs to sell what you sold. And that is your gross income. Then you want to subtract out all the other expenses that are related to running your business. Do you want to wait until the end of the year to do this? No. In fact, before you start your business, kind of like the lawyer Richard said, you want to project what this is for year 1, year 2, year 3. That'll help you in choosing your partners. That'll help you in choosing your employees. That'll help you in choosing your vendors. That'll help you in choosing your customers. And then, you'll want to know your expenses. You'll want to do something like this and look at it month by month and then look at the total. And there may be other income that you have that's not related to this particular business. And then you'll total it. So when people talk about profits or the net income, that's what they're talking about. Another document which is really important, now notice that one basically dealt with sales and different kinds of expenses, 2 chunks, directly related to what I sold and stuff I have to pay for whether I like it or not because I'm in business even if I don't sell a dime. The second is the balance sheet. Income statements are over a period of time, typically a year. You track them month by month over a period of time. The balance sheet, when you balance, think of kind of balancing on one leg, it's for a point in time. So it's this, what do you have? And it's about assets. What do you have that's worth anything? And I want to know for a point in time, like today, or yesterday, or 5 days from now. Not over a period of time, because it could go up and down. What do you owe? And what's left over? So in this, there isn't sales. In this, there isn't expenses, because that's not the point of that. This is like, okay, if I took you to the bank, what cash is available? And it's arranged, some of you may have heard this term, in order of liquidity. What things can be converted to money right away. So cash, you want to have. Other current assets could be, what could other current assets be? Inventory, okay. It's worth something, but it's going to take a little longer to convert. What else could be an asset? Property, yes. If you own the building. What else could be? Let's say you're making cookies or something. What else could be an asset?
The machinery.
The machinery, right. Now, when people are going into a restaurant business or something like that, I'm like, find someone who just went out of business that bought that expensive stuff, and you go and buy it from them. So yes, it's worth something, but when it's time to sell it, you might not get $30,000. Same way with a car. You take it off the lot, suddenly it's worth $20,000. You're like, but wait a minute. Okay, then you have fixed assets, again, liabilities, things that you owe right now. Long-term for the balance sheet is outside of that first year. And then equity, this is that owner's equity. So this is a formula that's very basic, that looks at different things. I'm not saying the income statement kind of looks at things from the right eye, the balance sheet from the left eye, but it looks at things from a different perspective. And then cash flow is very similar to the income statement, but it's only looking at the cash. Because some of you may have very little cash, but be sitting on very expensive property. But in this market, you might be sitting on very expensive property for a while. So, cash flow is really important. And, the being comfortable with knowing what data.
Get more business growth tips at www.GrowYourSmallBiz.com.